Hello, everyone, and once again, many thanks for tuning in to our latest investment video. Today, I have the pleasure of talking to David Walton, manager of the Marlborough European Multi Cap Fund. That is an integral part of our investment portfolios, and frankly, one of the reasons for our fantastic 2020 performance. But before we start, if you're watching one of our videos for the first time, hello. It would be marvelous if you could subscribe by hitting the subscribe button below. It'll be somewhere along here. Don't know which side, that one or that one. And if you found the content to be of value, let us know by hitting the like button below. We've a huge range of financial planning and investment market content delivered each week, so I'm sure there will be something that you will find of interest. Anyway, moving on to today's meeting, and David, thank you very, very much once again for your valuable time. Your performance, again, I alluded to at the beginning, your performance during 2020 was superb. What were the main drivers?
It was really, Andrew, by sticking to our knitting. Our approach is to buy well-managed companies with a good growth potential that are cheaply valued. And that's what worked for us in 2020. The same thing that worked for us in previous years.
Mm-hmm.
We didn't actually change the portfolio very much. So we stuck with our existing holdings. And despite the very unusual situation of the COVID pandemic, most of our holdings actually managed to do well in that situation, which was particularly encouraging.
Yeah, and certainly, Marlborough as a company, you're noted as bottom-up stock pickers, so it's great that you've got that dedication to your proposition and it's paid off. Now that Brexit has finally gotten over the line, and I've no doubt at all, as a European fund manager, you're absolutely thankful that this topic doesn't get raised that often. Should UK investors be considering upping their exposure to European equities?
I would say so, yes, because Europe offers a range of opportunities which you can't really find in the UK. In some respects, Europe is still an emerging market, in fact.
Mm-hmm.
For example, the fund's largest holding, which is called SESA, an Italian IT services company, is profiting from the rather underdeveloped nature of Italy in terms of investment in IT.
Mm-hmm.
For example, we all love to go shopping in the UK on websites, having things delivered to our house using e-commerce. In Italy, e-commerce penetration is about half of the UK.
Wow.
Similarly, in Italy, the investment in IT in the whole country is half what it is in the UK as a proportion of GDP. So SESA can profit on that tailwind of companies in Italy catching up, getting online, interacting with their customers digitally, which has obviously been given a big boost by COVID.
Yeah, absolutely.
So, yeah, so that's particularly positive. And I suppose one other reason to invest in Europe now is that we've had the rather long and tortuous Brexit negotiations, which finally have ended in a deal and not a hard Brexit. Clearly good for the UK, but also good for Europe because the UK is an important trading partner for most European countries. So it removes that risk.
Fantastic. Looking forward into 2021, how are you positioning the portfolio as we seem to be moving into a potential new cycle? The vaccines, the potential reflation trade, all of these different topics. Is that affecting what you do, or because of your process, are you pretty much sanguine with regards to that?
I think we have a portfolio which is diversified, but the biggest sector for the fund is industrials,
Right.
roughly 30%. And industrials will benefit from the ongoing revival in economic growth in Europe.
Mm-hmm.
For example, our Italian staffing company, OpenJob, recently made an acquisition in January of a rival, which will boost earnings per share by 15%. That company's PE is 10 times. So, it really is quite cheap. And typically in a recovery, if a company is taking on more staff, initially they will take on more temporary staff, as they're not quite sure whether the recovery will, take hold or not. So we do hold OpenJob in Italy, which is a staffing company. Also in France, we hold Synergy. another staffing company. They will both benefit from this recovery in growth across the continents. And other than that, I think we also see opportunities in a few larger companies. We've taken holding in the German software company SAP, where we see scope for them to catch up on their cloud software sales, which have been lagging behind some rivals. So we were able to use a profit warning from that company last year to buy in at quite a low price, and that's now having a bit of a recovery. Equally, we've taken a holding in the Danish company Novo Nordisk, which is selling a lot of drugs to treat diabetes, which is unfortunately a kind of ongoing growth in the world. So yeah, we're seeing a whole range of opportunities out there.
And just to finish off, it's in the name. You're a multi-cap fund, which obviously gives a bit of differentiation to you, aside from your peers. Touching on just what you said there, are you finding more opportunities in large cap, or are you still concentrated down with the mids and the smalls still?
The fund has a strong bias still to small mid caps, although we do obviously have some investments in large caps as well, which I've mentioned. But in terms of the smaller companies, yeah, typically you can get higher returns there, including from takeovers. And last year, the fund had 5 companies which had takeover offers, which is an important reason behind the fund's high returns in 2020. And going forward, we do see, as companies and individuals come out of the pandemic, people have been saving cash because they can't go out and spend their money. Same for companies. They can't go out previously and buy other companies because there's been no flights allowed. It's been hard to negotiate deals. Now, as we come out of the situation, we're seeing small deals being announced, which I mentioned before with OpenJob. Other companies are making bolt-on acquisitions, which increase the earnings per share. As the year goes on, we may well see some larger bids taking place, which could affect some of the fund's holdings as well. So yeah, I think there's going to be quite a big amount of money being spent by both individuals in Europe and by companies, which is going to be positive for share prices.
Yeah, and yeah, that's it exactly. I think we're moving into a situation where, a lot of people talk about our equity markets in a bubble, and that's not for me to speculate. What we do know is that there's a lot of pent up demand. Although people not spending money. I wish someone would tell my wife that, because she's kind of enjoying herself with the old Amazon and whatnot. But yeah, there is a lot of pent up demand, and I think it's going to be interesting, especially with yields rising in fixed income. And investors have there's a lot of opportunities if you invest with the right managers. And again, like I said at the beginning, your fund and yourself, you're core to our equity portfolio performance. So once again, thank you very much. It's been an absolute pleasure to speak to you again, David. You take care. It's snowy outside, so keep wrapped up warm and get out and sweep the pavement, because it's going to be a cold one tonight. Yeah, thanks very much. We'll catch up soon. Thank you.
Okay, thank you, Andrew. That's great. Thanks very much.